welcome to Theo Trade. This is Don Kaufman. It's January 16th, 2019, and you are watching the Theo Trade evening video. Just about 8 minutes left in today's trading sessions, and the S&Ps, once again, staging a move to the upside, up some 13 handles, but fading hard and fast off of the oh-so-important 2626. For those of you that do not recall, or maybe just haven't been around very long, 2626, what is it? It's one of our gravity points. Now, again, if you don't know what the gravity points happen to be, I'm going to open up. It's a 180-day chart, okay, based on 4 hours. And you can see specifically all the different gravity points effectively along the way. Now, we've been talking about these gravity points for over a year now. Why is 2626 so effective and so important? It is the bottom kind of rung in terms of our volatility box. Now, again, we have 2575 to the downside, but the bottom rung, and really the bottom of the volatility box that we were trapped inside of from October all the way through November, we just clipped right back into the effective bottom of that. Now, breaking above 2626, does that per se make us bullish in this marketplace? Absolutely not, okay? The market right now still effectively belongs to, well, not so much the NASDAQ, because again, a lot of people still have a huge, focus on the NASDAQ, focus on the monsters of tech. But this rally, not just today, okay, but much of the recent rally we've seen inside of this S&P 500, it belongs almost exclusively to the financials, specifically the XLF. Now, yeah, we could talk about Goldman Sachs, which is up, almost 10% today alone after its earnings, and we'll come to that in just a moment. But the important point to be made here inside of the XLF is the XLF has its own little kind of Maginot line, and that one happens to be none other than, I'm going to make this clear, 2650. Now, anything under that 2650, the marketplace, still in heavy volatility, still a degree of bearishness. Now, that's tough to say after having seen, this wicked rally. Clearly, yes, I have seen the market touch down to 2,300 and rip back 2,600 and then some. But again, as long as the XLF is still weak on a relative basis, we're on pins and needles in the marketplace as a whole. One other point to be made with this marketplace is that it is entirely, momentum type driven, especially again on a day-to-day basis. For those of you that are intraday traders, when I say momentum driven, the point to be made here is Bank of America, they had their earnings today. Goldman Sachs also had earnings today, explode to the upside. Now, Morgan Stanley, well, guess what? Did it have earnings today? Absolutely not. In fact, its numbers do not come out until tomorrow. Yet it's still up 4.5% predicated on nothing more than a momentum-based trade. You could say the same is true for JP Morgan. When JP Morgan, I'm actually going to go all the way into a 1 minute time frame. I'm going to go 1 minute, and I'm going to open up just the last couple of trading sessions for you guys to take a little bit more detailed look in here, because I think it's incredibly important. When I say that something is momentum driven, listen, JP Morgan, after the earnings announcement, was down quite considerably so, about what, $3.50, rallied out of the hole with the rest of the marketplace. The same could be said, of course, of Citigroup, having released its earnings, and was down in the after hours, only to rally back. It's a momentum-driven marketplace at this point in time, So you say, well, why fight it? Well, I'm not actually arguing with that at all. Why fight it? In the near term, look to the gravity points for answers, as we are now back again to the bottom of the volatility box. If we continue any higher from here, you got a straight shot to 2682, and then we're going to start pinging back and forth specifically between these gravity points. If you don't have the gravity points, there they are. Listed in all of their glory right in front of you. But we actually tagged again that major level here of 2626, during today's trading session, pulled right back off of it. Again, a little bit of a bid coming into the close. Nevertheless, this is all, again, it's all about the financials in today's trading. Now, to continue on with kind of a theme of maybe a little bit of underlying bearishness to the marketplace, I want to show you something Very, very interesting. And you're going to have to kind of follow along because we're going to cruise back and forth between the trading application, of course, and this PowerPoint. And this has to do with what we term net outflows. Now, this particular slide and this entire idea was brought to me by a very close kind of quantitative friend, a gentleman from the business I've known since I'm a kid. He brought it to my attention and he said, hey, have you looked at the ETF inflows and outflows, year to date? My first thing was to him, I said, listen, year to date, come on, we're 15, 16 days into the year. What do we have to really look at? He goes, well, we all recognize that December was absolutely horrific, right? December in terms of outflows. But if you've never looked at something like this before, first of all, I find the ETFs incredibly important and effective, at kind of handicapping what the marketplace is doing and likely to do, in the very near future. And the first thing that I'm bringing you into over here happens to be what we term outflows. For those of you that have absolutely no idea what an outflow is, it's money coming out. It's that easy. And this is actually the monthly flows. Again, this is as of yesterday's close. You could only really look at it at day's end. So you might not necessarily know what the VOO is, but it's the Vanguard S&P 500 ETF. Very, very similar, in respect to what the spiders would be. The net outflow, $2.4 billion. This is a Vanguard real estate fund, net outflow. Vanguard information technology, net outflow. Consumer discretionary, XLY, net outflow. I can go on and on. The Qs are on this list, net outflow. Now, before you get too crazy, I can also show you, net inflows. And I will show you that here momentarily. But I want you to look at the physical chart of this. And that is, let's go look at something like XLY. If you're not familiar with it, again, it's consumer discretionary. Consumer discretionary, it's a $104 product, trading just about a 20% implied volatility. This is also heavily influenced, by Amazon. Has that thing rallied up enough? Are you not impressed by the rally over here? When you start to look at a year-to-date percentage, it's only up about 5%. On a year-to-date basis. But snap that chart for a second to just 1 year, just year over year. And you can take a look from the bottom of this, It's down about 12%. Now it's basically flat. It's about 12% rally, And yet, up until this point in the month, there has been, again, 1.25 billion in terms of outflows. How is that even possible? Well, one of the primary ways is, we could have actually sparked some of this upside potential here with nothing more than short covering. Short covering can effectively explain a lot of this. There's the closing bell. So short covering sparks a little bit of move to the upside, right? Because short covering is not necessarily inflows or outflows over there. It's covering an existing short position. But again, during this time when we have this wicked rally, no doubt. This is actually an outflow specifically inside of the XLY. You can go through and take a look at this. The healthcare sector also kind of made the list, just shy of about $1 billion. The XLV has actually been ripping to the upside. Same, and the very last but not least on here is the IWM. Now, this just happens to be, this is the top 10. And again, just top 10 ETFs. There's been a lot more in terms of outflows, but this is the top 10 ETF outflows, And again, this is the monthly flow, which really has began in, of course, year to date. Next, let's look at net inflows. So the net inflows, well, I looked at this immediately and I thought to myself, look at these net inflows. 3 billion, 3.7. Again, the biggest net outflow was 2.4. So immediately you start looking at this, you go, no, the inflows are way bigger. And then you start to read down the list and start to recognize where we're actually flowing capital to. What ETFs? Bond ETF. What do we got over here? Wow. Emerging markets. That's a wild one. I'll come back to that in a second. What's this one? Bond ETF. Bond ETF, Bond ETF in here. All right. This is actually total stock market ETF, which this VTI, also very similar exposure to like emerging markets. On the bottom of this, again, we have more emerging markets on here. It just goes on and on. Obviously, somebody feels that there's going to be weakness in the dollar and that we should effectively run to bonds because this is big capital. okay, in terms of net inflows. Have a little look at some of this. Again, it's a very, very interesting perspective because when I look at the TLT, and by the way, the TLT did not per se make that list, but when I look, okay, at a major, okay, ETF product like the TLT, wait a second, there's some sell side activity in there. What gives? Underneath this marketplace, things not necessarily as rosy as they may currently seem. Again, volatility has died down. VIX is back down, what, 18, 19? Don't get off your game. I will remind each and every one of you, this is precisely where volatility was sitting all throughout the month of October. Volatility has kind of found a little bit of a base, if you will, right around the 18 handle. Again, this is exactly where we were all throughout the month of October and November, in which there was some fairly extreme, sell side activity. But even after seeing the S&Ps rally 300 points, and they have almost to the point, have effectively rallied, 300 points. By the way, it's 23.16 to 26.16. Close enough for you, right? 300 points to the upside. Volatility still does not abate. Get on your game, and you better realize, that volatility, even though, you're going to succumb to the idea, this could actually be the beginning of something big to the upside. I've told you time and again, this market is going to be great at getting everybody to bite on the fact that it is okay to buy stock. Underneath, you just saw it. Those net outflows, they're scary. Capital is flowing out of major ETFs, major sector ETFs like XLY, and it's flowing into shorter duration bonds. Very, very scary outlook. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.